If you're going to do real estate and you are an active investor, no matter what they tell you, it is going to take time. There's no such thing as completely passive mailbox money as an active investor. Here's the thing that I really want everyone to listen to, especially the newer investors. On paper, it makes total sense for you to buy at the bottoms. It makes total sense for you to be greedy when others are fearful. What they don't tell you is how difficult it is to actually do it, because you are going absolutely against the grain. What you're going to see is everyone in your friend group, your family, the media, they will all be telling you you're crazy, and you're going to have to go against that.
Guys, welcome my good friend Mikey Taylor. Dude, what's going on, man?
What's going on? It's great to see you again.
Bro, it's so good to see you. You know, you guys have been growing like crazy over at Commune Capital, man. That's amazing, dude.
Thank you. It feels good. The first few years of any business is brutal. You feel like you're pushing everything uphill, and then you have these moments where it gets a little bit easier. Yeah. And so, we're experiencing that, but it'll just be a matter of time till we have to push it up the next big hill.
Yeah. A good friend of mine says that everything starts, what does he say? It's like it starts to nurture, then it goes to suffer, and then it goes to performance, or something along those lines. And that's been my experience too. So, I've recently exited a business I built over 25 years, uprooted my entire life, moved my entire world to Utah because I love this area. And next thing you know, I'm starting, and ironically, next year, when I get a certain portion of capital coming in, I'm going to be looking heavily at commercial real estate. When I say commercial, it could be multifamily, could be live event centers, what I have in Raleigh. And I thought today would be really cool because you're an expert in this field. Obviously, you went through the business exit yourself after being a very successful professional skateboarder, sold a beer company, the whole deal, got into investing yourself. So I was hoping maybe we could do a masterclass for those who are in my season or looking to be in my season and figure out, okay, I got capital come in. What do I do with it? So maybe start us off by telling us why you chose commercial real estate to really kind of be an anchor of your portfolio.
So it's a really good question. For me, the first business I did was in the beer industry, and I did it with two friends. We had no business experience. The amount of risk that we were taking was great. And we brought on investors. Now, it worked out. We sold our business. Everyone made a lot of money, but it was one of those kind of big return, but also came with big risk type of investment profiles. Yeah. And it's not to say you shouldn't be investing in those things, but after I sold, I had a lot of people from my past life, which was the pro athlete, pro skateboarder career. And I was more looking at them. I was trying to figure out how I could help athletes plan for their future when their careers ended. And in doing so, you maybe want to put some small amount towards the high risk, but you want the majority of your portfolio in investments that are going to be there and that can weather a storm. Yeah. And so when I started basically coming up with the idea of the next business I was going to start, I was looking at the assets that I was investing in that were always there for me. And at that time, it was storage units and apartment buildings. Yeah. And so I just picked those two assets because I had a great experience with them. And I felt comfortable bringing that to other athletes. And then as we started basically growing the business, I started seeing a lot of correlation with athletes and then normal or maybe more conventional careers, right? You have your sales guys or sales girls. They have a very similar pain point, which is my year starts over every new year and I can't step off the gas or my whole lifestyle goes away. Yeah. And then even all the way to entrepreneurs where, we get in the grind of, or I would say we run the risk of becoming a slave to our business. Yeah. And we're all trying to find some type of option and then ultimate freedom to where we get to choose what we want to do instead of having to do the things or responsibilities in front of us. So that's kind of where I landed on it.
Yeah, no, and look, I love those two segments. I've heard great things about apartment buildings. One of the things I think people find confusing is there is an approach to become a bit of an early adopter in investing in commercial real estate. And I'm happy to recommend your firm to the audience because I know how you operate as a human being. I know you're big into the family. Obviously, you were led by a core mentor. We talked about him the first time you were on the show,
Yeah.
and I just find a lot of value there. But more importantly, I find that I know that there are other thought leaders out there that are trying to get people to kind of come into their commercial investment pool. Cardone comes to mind. Um, you know, I'm curious to know, at what point does it make sense for someone to start their investment journey? At what point do they have enough liquidity to even get started in this field? And what do you think sets your firm apart from a lot of the other thought leaders that are also investing in commercial real estate nowadays?
Yeah, good question. So there's a couple hurdles. This is I would say, one of the cons when it comes to real estate, and then more specifically, the private equity side of real estate
Yep.
is the accredited investor qualification.
Mhm.
So to invest into a firm like mine, or many of the private real estate offerings you're going to see, you need to be an accredited investor, which means if you're an individual, you make over $200,000 a year. If you're married, it needs to be $300,000 a year, or you have a net worth north of $1 million, excluding your primary residence. So
Mhm.
you already have a pretty big hurdle to get past. That's the first part.
Yeah.
Now, to answer the second question on how much money do you need until real estate starts making sense, most investments like mine, the minimum investment's going to land somewhere between $25,000 to $100,000. So
Mhm.
you got to get somewhere between there to even qualify for the minimum investment.
Yeah.
But even if you have $100,000 liquid, it doesn't always make sense to put the whole thing in real estate. What you want to do as an individual is go, okay, one, what happens if things go wrong in my
Yeah.
life? What if an unexpected issue happens? You're going to want some capital or cash set aside to float you through those honestly uncomfortable scenarios.
Sure.
Once you have that built out, and now you're kind of addressing some of your short-term goals and long-term goals. On the long-term goal side, if you have $100,000, that's probably when real estate starts becoming an option or a viable option. Now, what makes my firm different than the rest? Oh, there's probably a few of them. I would say most firms that we're competing with they're built for institutional investors. So what you're going to see is it's the same amount of work to basically bring on an investor for $100,000 as it is to bring on an investor at $1 million or
Yep.
10 million.
Yep.
Same amount of work.
Yep.
So what you start seeing is firms basically, get created, and then they start spending their energy on the big check writers because it gets them to scale quicker.
Mhm.
For our firm, we made a decision early on that we are building this firm for us. We are stronger together. It is built for what we call the retail investor. So we can all put our capital together and then contend with the big institutional funds. So the $100,000 check, that is the majority of the people that come in with us. And then I would say, the second thing, our team is very unique. One, I was a skateboarder, then I, built and sold a craft brewery. That's not the normal storyline for somebody who builds an equity firm. The normal storyline is I went to school, I got my MBA at USC, I spun up a private equity firm. That was my path. I'm also a city council member. And then my partners all come from the financial world, CFAs, CFPs. So we actually have a very unique outlook where I tend to see things differently. I'm definitely more contrarian. I'm a contrarian thinker. And then I'm surrounded by people that do have more of an institutional outlook. So we were able to blend both worlds, but build it for our avatar, which is it's us.
I love it. Well, I think the other thing that sets you guys apart too is outside of just the skill set, it's the humble, principle driven mindset that you guys use, one. And two, another thing that I like is it's kind of a common sense approach. I mean, you guys pay attention. You're not, I've seen this a lot. And obviously in the worlds that we're in now, we see a lot of P&E firms that I see. They get an acquisition, and it could be multifamily, it could be something else. They get really overconfident. They start letting loose on the principles. The next thing you know, the asset that you thought was going to bring you a return is doing bare minimum to holding steady. So I love the fact that you guys do that. I also think there's an interesting correlation. I was hoping we could talk about this a little bit. It's one thing to have liquidity, and you see, like, here's an example: someone wins the lottery, right? You win the lottery, you get a bunch of liquidity all at one time after you're paying all your state and federal fees and all that stuff. So you got liquidity, and you're like, okay, I'm gonna go buy all the fun stuff I never owned before, right? Well, but you and I both know that's not the best use of liquidity. But let's say, okay, now I got liquidity. Even if they have liquidity, they technically pass the accredited investor test on paper, but they don't actually have the skill set to know some of the important matters that you would find in real estate. For example, cap rate. And I want to break some of these terms down. And I was curious to know how you guys go about maybe kind of schooling some of your investors as they're coming on board to make sure they understand these terms, what they mean, why you guys are looking at the deals you're looking at, why you choose to invest in the deals you look at investing in, that kind of thing.
Yeah, so we spend a lot of time on educational content, is to answer your question. So, we have videos in our library that go all the way from, if you're an investor and looking to invest in real estate for the first time, here's a list of all the questions you need to ask and what some of those questions mean, as you brought up cap rate, et cetera. And, from there, even the investors that end up coming in with us, there's a big push on our company that is very educational. So it offers I would say, ability for any of our investors to, one, know what's going on, and two, if they ever want to get to a point where they're doing it on by themselves, we feel like this is a great opportunity for you to get money to work, have experience as an LP, and gain some of the educational information that you would gather as a GP. And so that's just part of our, I would say, value add proposition. Because unfortunately, this is the experience for most LPs, right? The GP comes in with all the information and no money. The LP provides the money. And at the end, the LP has no money, but has all the information, right? And we're trying to flip that. We want the LP to make money, and we want them to learn something along the way.
Yeah, just for the sake of clarity, just for the audience, because again, I was actually thinking about this. Outside of my exit, most of my wealth has come from real estate,
right?
And commercial buildings, light industrial, looking at doing multifamily in the future. Terms like GP and LP, like, just for the audience sake, give them an idea what those terms mean.
Okay, so it's part of the partnership structure. So you have a general partner and a limited partner. Now, when we talk about passive investing, or you making money and you don't have to do the work, LP is how that's created. And basically what that means is you're investing with an operator or a group that is finding the assets, underwriting them, securing the financing, managing the manager. They're doing the work. And you are making a return because your money is invested in the project. So that's an LP or a limited partner when you come into a partnership like that. And look, there's different ways to structure it, but if you're going to do real estate and you are an active investor, no matter what they tell you, it is going to take time. There's no such thing as completely passive mailbox money as an active investor.
The closest thing is having a debt-free property. That's about the closest you can get to it.
You can get close. You just can't get all the way there.
Yeah, right. Oh my goodness. Well, let me ask you this. All right, because again, this is someone with your experience in this, and I've been watching you work the business now for several years. Since we first got to know each other a few years ago, and I love what you guys have done. What do you think most investors, early stage investors, are getting wrong about this field, and what do you hope that we can help them get right?
Okay, I would say there's two major things that we see kind of newer investors get wrong. The first one, they only focus on return and they do not focus on risk. I would say that's the biggest. So they look at, let's say, 3 different real estate projects, and they typically pick the one with the largest return, but they don't necessarily have the knowledge yet to understand how that group is getting to that return and the added amount of risk to get you there, right? So I would say that's the first one. You have to include risk into the return profile, because at the end of the day, we're trying to figure out what the return that actually makes it in our pocket is.
Yeah.
A paper return means nothing, right? And then I would say the second one, newer investors focus on quick money.
Yeah.
It's okay, if I invest in this deal, what do I get in my pocket right away?
Yeah.
And I actually think that's not how to look at investments. Investments are meant to be wealth builders.
Yeah.
They're not meant to be active income.
Yeah.
And so sometimes we like the idea of money actually coming into our pocket because we feel it.
Mm-hmm.
But if we're really talking about growing our wealth, that's done on the back end. That's not the stuff we feel.
Yeah.
And so you just need to balance that out. And I would say the final one is ask yourself what the money's for, right?
Yeah.
If you're our age, I don't need a return today.
Yeah.
I would actually rather delay my return so I have the opportunity to double it in a quicker time hold.
Yeah.
And then I want to do that over and over and over. And so, ask yourself, what is my goal here? What's the money for? And if it's long term, don't worry about what you're making, the first quarter in cash flow. It's just not that's not the outlook for a long-term investment.
Yeah. I think that's brilliant advice, because to your point, I think people a lot of times, especially early stage, you get into looking for the dollars back, but you're not looking at the compounding.
Right.
And investing as a whole, doesn't matter what you're investing in, it's a long game, right? You might put money in year one, and you might honestly not even take some capital off the table till like year 10.
Yeah.
If you're playing smart, because you're going to weather some economic headwinds, or tailwinds for that matter. I mean, you got all these different types of things that you're going to focus on, which brings me to the next point. So we're obviously from all of my real estate investor friends, especially in the commercial real estate, especially in the office space category, dealing with a lot of challenges right now. Sincerely, or seems to be mostly tied to the cost of capital. And for the audience, say cost of capital, meaning interest rates that people get debt from to buy these properties or a portion of these properties. What types of things are you guys doing differently to try to, work your way through some of those challenges?
Okay, so those challenges, there's depending on the stage in the project that you had in the works, it could be a very painful moment for you, or it can be actually a buying opportunity.
Okay.
So for real estate developers, right?
Mm-hmm.
Or somebody doing a value add, let's say, opportunity. So they bought, let's call it an apartment building. They wanted to do a renovation.
Yep.
You're typically putting on bridge debt or construction debt. This is short-term financing.
Yep.
Because the property doesn't qualify for the permanent financing.
Because it doesn't exist yet.
It doesn't exist yet. So you're getting, let's say, a bridge debt for 3 years, and you're making assumptions in the future on where interest rates are going to be, where cap rates are going to be, et cetera.
Yeah.
Well, if you started a project in 2020 and you were expecting interest rates to be at 5%, and the bank to lend you, X amount of dollars, those numbers aren't here now. Now interest rates are higher and banks are lending you less, which means a lot of operators are having to come up with the capital to qualify for the deal.
Yeah.
And in a situation where your property is distressed, it is very difficult to get capital. And so I would say for some investors, this is a painful moment for them.
Yeah.
For us, we are in a buying kind of window right now. We are looking at either operators that I just, spelled out that are distressed, that we're able to get a project for a discount.
Yeah.
We're looking for people that wanted to sell last year, weren't able to, and are now willing to sell it at a discount.
Yep.
So that we can buy it at a better price.
Yeah.
Now, on the financing is still more difficult. So what that means for us, we're having to put way more money down today than we had to 3 years ago.
Yeah.
So an equity check for us is now about 45% of the cost of the project. So on a $40 million project where we used to have to put down $9 million, $8 million, now we're putting down closer to 20.
Yeah. Yeah. Well, I think that's important to know, because I think it also goes to show that they always say that, and this, I'm a hockey guy, so hockey analogy, right? Skate to where the puck's going.
Yeah.
Right. And the best people that I know in the business, like you and your firm, for example, are great at this, are great at looking at data and anticipating that data and getting a good baseline on kind of where we think the puck is going.
All right.
I'm curious to know from your perspective. We're heading into an election cycle, which always gets crazy. They pump fear like crazy into the marketplace, which sucks.
Yeah.
There's gonna be people that say, okay, well, things are in their term great now. it's going to get worse if someone gets elected or vice versa. What do you think the interest rate market looks like with the fact that inflation keeps hovering around 3%? Do you feel like we're going to be in a whole pattern with the Fed for a while? Do you feel like they're going to loosen up and start going backward maybe mid next year? Kind of what is your, I mean, a lot of this is very subjective and gut, of course, but I'm curious what you see on the tea leaves.
Okay, so considering we don't get slammed into a big recession, considering that, I think we're in a holding pattern for a few years. I don't think it's going to ease up significantly for a while.
Yeah.
And then once it does ease up, I think it's going to go back to probably 2018, 2019 rates. I personally don't think we're going to see these 2 or 3%, 30-year fixed rates again. I think that was once in a lifetime. Now look, can we get in a scenario where the economy just freaking bottoms out and we have to drop rates because of that? Yes, that's a possibility, of course. I just think that's a lower probability. I think probably the highest probable outcome is we see the rates stay where they're at for a few years, and then somewhere in that we see these very small decreases, but I don't think it's going to be significant.
Yeah, I think we're probably looking at a quarter of a point when they start going backwards a little bit. And I agree with you. I think we're 5 or 6% is probably going to be baseline.
That's what I think too.
Once we get to what I would refer to as more of an evenly keeled, healthy economy.
That's what that's where I think it lands also.
Yeah, so that's good to know. When it comes to the overall investing structure, and we're talking about the early stage investor for the sake of the show. We're trying to get them a line of sight on risk. Let's talk about risk a little bit deeper, if that's okay.
Yep.
What are 5 tips that you think are really instrumental in reducing your risk when you're looking at jumping into the investment pool?
Okay, so if we're talking real estate, actually, this one will cross over to any asset class. Diversification helps reduce risk. It always does. And then anytime you can invest in investments that are uncorrelated, that is significantly going to reduce your risk. So, that used to be stocks and bonds.
Yeah.
You invest in both because when stocks are good, bonds are bad, and vice versa.
Yeah.
Unfortunately, we're living in a time where the last 2 recessions, it was like stocks, bonds, and public REITs all dropped together. So I think you need to go into the private kind of, investment world to get a little bit more uncorrelated investments, but diversification is going to help.
Yeah.
If you're investing in real estate, I think some of the things that you want to look at to protect yourself or give you, downsizing the risk is, one, what happens if things go wrong? This is a really important one. Right? A lot of times operators are going to sell you this very rosy picture of we've been doing this over and over and over, and this is what you're going to make. Yeah. Some of the stuff you want to ask yourself is, what happens if cap rates move? What happens if interest rates move? What happens if the project is delayed? What happens if cost goes up? Right? And then when you're starting to rent it out, what happens if it takes longer to rent out, or if there's a rent reduction that we have to give so that we can rent it up to a higher occupancy? And when you're looking at those what ifs, you want the operator, or if you're an active investor, you want to run the modeling to see, if this scenario happens, how does that impact my return? And then what we do as a firm, we look at if basically all hell breaks loose. What happens if we are in doomsday scenario? It's 2008 all over again. What happens to this investment? And we like to see a scenario where we're still making money. Might not be a lot, but we still want to be somewhere positive for us to move forward on a deal.
Yeah. Profitable is always better than losing money, for sure.
Well, yeah, especially look, you go back to 2008, like, it was a dream to make money during that year. Everybody was basically taking L's, And so to be in a scenario where you might make 5% on a deal when everyone else is losing money, that's not a bad day. Now, that's a big haircut from 20% if everything went right. But I like trying to see an outcome where it looks like there's somewhat of a floor. That's a better day for me.
Yeah. Well, not only that, if you can get to a place where you're in a worst case scenario that your return is exceeding the cost of inflation, by decent percentage or a margin, then you're normally in a pretty decent shape. Right. Which that 2008 just made me think of something really fast. So in 2008, my first mentor, Steve Meyer, you and I talked about him last time on the show. Just a quick refresher. He invested in me with knowledge, knowledge. I guess I should probably say it right, but invested in me with knowledge and taught me a lot. But when he did that, he always gave me this principle. He said, the bear is always trying to bite the bull, and the bull is always chasing the bear.
Yeah.
Right. So he was trying to get me to understand that in world economies, local economies, everything is seasonal. Right. You might go on a run for 10 years, like what I think we're just kind of coming out of with a dip. You might go into like in 2008, several years where everybody's digging out. And one of the things he told me is essentially what he was saying in my younger age, because we weren't talking in investment language at the time, was to always try to have some capital on hand, because he taught me the principle of fear. When the world is quote unquote falling apart, recession's happening, 2008's happening, global banks are doing this, or banks, like he just says, you need to be the person that can think and not feel in those seasons. Like you need to think responsibly, and to have capital on the sidelines, because one of the things that he did in the mid 90s, when the mid 90s was a big challenge economically, he actually had capital sitting on the sidelines, and he waited till basically the fire sale began and went out and bought all kinds of things, and he tripled his net worth.
Right.
Right. So from a principle's sake, I'm curious to know, when, from your perspective, does it make sense to sit on capital versus when does it make sense to invest capital?
Yeah, really, really, really good question. So, look, I have attempted to always have a war chest of capital on hand.
Mm-hmm.
If we're timing the market, yeah, it always makes sense to buy at the bottoms. Now, it's very difficult to time where the actual bottom is.
Yeah.
And so for me, I've been able to somewhat get there by a buy-sell discipline or a buy-sell strategy. So when I'm investing in a certain asset class, I allocate a certain percentage that's going there. And when things appreciate, that brings my allocation up beyond my threshold. And that's my trigger to sell. And then vice versa. When markets drop out, that brings my allocation below, and that's my trigger to buy. That's helped me basically be less emotional when it comes to investing. But here's the thing that I really want everyone to listen to, especially the newer investors. On paper, it makes total sense for you to buy at the bottoms. It makes total sense for you to be greedy when others are fearful. What they don't tell you is how difficult it is to actually do it.
Yeah.
Because you are going absolutely against the grain. What you're going to see is everyone in your friend group, your family, the media, they will all be telling you you're crazy.
Yeah.
Right. And you're going to have to go against that. And so for those of us, and I understand it because it's human nature, we find comfort in doing the things that the person next to us is doing. It takes very thick skin and an ability to hold your emotion back for you to act when others aren't.
Yeah.
And so it's learned that discipline will be created when you do it, but the first time it is not easy. 2008 was not easy for me to do it. After 2008, I'll be doing this for the rest of my life. It just is hard in the beginning.
Well, I think it goes back to a term I use all the time, which is principles govern promises, right? So if you have strategic principles in place, they make your decisions basically before you have to make them.
Right.
You talked about thresholds, and Steve was telling me all the time, he says, kind of operate in the gray. Rather than trying to time the bottom or time the top, get within a threshold of the bottom and then get within the threshold of the top, you buy and sell. And I think that's kind of what you've just described there. Because I do feel like when it comes to money, people handle money with more emotion than logic.
Okay.
I know for a fact, after going through my own financial crap, that I made a bunch of emotional decisions, got me in a lot of trouble, and then had to dig my way out and start all over again. So now I typically have a threshold, a little war chest of cash, like you're talking about. I got a little thing sitting to the side. And if my cash position gets low enough, then I stop, or I slow down, or I get out there and hustle for some extra income. Maybe I'm doing some more speaking events, or whatever the case may be, to kind of bring that level back to baseline. Because again, this is a season, right? So it doesn't matter. And honestly, this is for any business. All businesses go through seasons, and investment classes are no different.
Right.
I'm curious to know. So there's a lot going on with AI nowadays. A tremendous amount going on with AI. Have you guys been able to see a resource where AI makes sense for you guys to deploy in your business? Or are you still kind of waiting to see how the technology plays out?
We're using it on a lot of our communications. So, investor updates,
Mm-hmm.
transcripts, all the way to leads. So when leads come in, we have AI software that's creating messages
Mm-hmm.
to communicate to them along the process of whether it's getting on a call with us, getting information, etc. So we're using it more on the marketing side. We have not found a tool yet
Mm-hmm.
that we are bringing into like the actual operations of the business.
Mm-hmm.
I think we'll get to the point where you're using AI to model your deals. We're
Yeah.
still using a human to do that.
Yeah. Yeah.
But on the marketing side or the communication side, just the little bit that we're using has been massive.
Yeah.
This will be a game changer. Absolutely.
Yeah, I think that's what I'm always so curious about when I get to talk to successful entrepreneurs and investors and business owners and whatnot. It's always interesting to see who's using it and how they're using it currently, what their anticipation factor is, what they think the disruption factor, and we all know it's going to be a pretty massive disruption long term. How people are going to be kind of positioning. I've got folks that are very AI. They want everything to be done by AI. It seems like the vast majority want a collaborative approach to human AI together to make, in theory, wiser decisions, model deals, even have time buys and sells for at some point. But I know we're a little ways away from there because the AI obviously has to learn the behavior, the thought pattern of the investor.
Right.
So yeah, I was just curious how that does that. That's always makes me excited.
Yeah, it's cool. Like, but we're definitely more collaborative with it. Like, I use it to speed up time. It's more to build a framework, really. But we still have to be involved right now. We don't have any platform that's just running without us.
Yeah, no, I love that. All right. So you started a show. You're now on YouTube. You're climbing the ranks, subscriber wise. Everybody's learning more. You're uber successful. I know you're a wonderful dad and a great husband. I know you spend a lot of time with your family. I know you now serve on the city council. Like, dude, do you not have enough things to do? I mean, like, what made you want to do it?
Yeah, I know. No, I'm at.
I love that. I love that deep thought.
I'm at. I have enough to do now. I am at max capacity. Everything that I'm asked right now is no. I can't do anything else. The decision to do a podcast and focus more on YouTube, I think was more a business decision. Like, how could we extend, or create another offering that is, gives more long form content, which I think is just a better delivery when it comes to trust build
100%.
and also learning. So I just wanted that to be a part of the business. The podcast, I don't know. The thing about the podcast, I wanted actually a little bit more flexibility to go beyond real estate.
Yeah.
Because in my life, there's a lot of like different factors. It's like, I'm a dad and husband. That's that's a very, very hard thing and beautiful thing at the same. Yes, right.
Yeah.
I'm a business owner. I'm on city council. I used to be a pro skateboarder. I was in the beer industry. Like, there's a lot to talk about here.
Yeah.
So I just wanted to be able to incorporate some of those other things.
Yeah.
And then the city council thing was actually more a conversation I was having with my wife, who felt like our community was missing things for our age demographic. And she wanted to look at another place to live. And I was like, I didn't want to. Like, I love where I live. And so I just basically threw it out there. Like, what if we're a part of the solution? Instead of us just looking for a grass is greener scenario, what if we help create the things we're missing? Yeah. And so I didn't really realize what I meant when I said that, or I didn't realize the amount of time that was going to go into that. But I wanted to find something that, one, I felt like my skill set could add value to my community. And two, I have a business. Like, I can't go all in on the new thing. My business is not at the point yet where it totally runs without me. And so I just felt like city council was actually that perfect blend to, it's in my wheelhouse. Yeah. It's a more of a, call it a side hustle. I'm a policymaker, not an implementer. Yeah. And so I went for it.
Yeah.
No idea what that meant. Had to run my first campaign. It was a lot of learning. It was
Yeah.
fun and hard and challenging. But so far, I'm glad I did it.
Yeah, no, dude, I love that. Well, I'll hit both of those. So I love the fact that you're trying to use the show to get outside of just investing. There's content I saw that's related to social media versus actually having real
Yeah.
content. You have a lot of great thought leaders on in their genre, in their space, which I think goes to show one of your superpowers as a human being, which is the ability to build amazing relationships.
Mm.
And one of the things that I personally struggle with, just being transparent with you and the audience, is now that I've had an exit, and I've got there's a game plan in place for that exit to double or compound. Everyone in the woodwork has come out and wanting me to do this, that, or the other thing. And and everybody, to your point earlier, it all sounds good. Send me your deck, send me your pitch deck, whatever. I like the operating business space. I know Tony's really big into this new private equity firm he's put together. No surprise.
Mm-hmm.
I like real estate because that's what I understand more of. How do you decide when to get involved in a deal versus to kind of like walk away from a deal or just pass? And that's a bit of a selfish question because you're further ahead than I am with the investment.
No, it's good. Honestly, for anyone who's sold a business before, you're going to know this. For anyone that hasn't yet, here's some things that just pay attention to. It's really cool. It's really exciting. It adds a new type of challenge, though. It doesn't make everything easy. It just is different, I guess is the best way to say it. In the beginning, you're probably going to invest in some stuff that you shouldn't. Like, that's the truth.
All that
man.
learning.
you know what I'm saying? Like you just have more money and you're like, I have the ability
Probably
to
stay away from the worm farm,
Yeah. And so, look, I did it too. I invested in some stuff that I shouldn't have. It was just, I was looking at way more dollars to participate in and was trying to stretch it out into more investments. I had to learn basically what I wanted to invest in and what the purpose of the investment ultimately could become. Now, what works for me doesn't mean it's going to work for you, but this is what I found. I like investing in things that, one, I'm interested in, and two, I have the ability to help drive that value up.
Yep.
And so I've spent 20 years building this vehicle of, having an ability to highlight items or services or products. And so, of course, like if I'm investing in something, I want to be able to plug that into my system because why not?
Yeah.
And so I'm looking for stuff like that. But at the same time, I'm looking for some diversification as well. So for me, I understand real estate and I enjoy building business. So the majority of my time, energy, and money is going into that. Now, when we get into like tech, I'm not a tech dude. I want some allocation to tech though. So I'm looking for those operators. It's a similar strategy when you're basically doing your due diligence on an operator, regardless of the asset they're in.
Yeah.
So I'm asking a lot of the same questions an investor would ask me. Yeah. I really like the financial space. So, I look for opportunities to blend the two with fintech.
Yeah.
But it's more than anything. It's picking what you want to invest in, having the allocation and not going over it. That was a big one. Like I had to get to a point where I had enough invested in tech startups. And so anytime somebody reached out, I had to say right away, no, don't send me a deck. I am not investing right now. My money is allocated. I'm not going to string you along. I'm just not in an investment time right now. Once something changes, I'm hitting you up.
Nice. The tech slot is difficult for me because either you find a unicorn or you find a snail.
Yeah.
It's I haven't seen an evenly balanced tech deal at least come across my desk where I don't know, it just feels like it's going to have even kill growth. And what I see in the tech space is a lot of like either rocket ship growth or pitfall, decline.
Yeah. Yeah, I hear you on that. If we're going like through like my actual asset allocation, it's heavily private real estate, private equity, private credit. On the tech side, it's smaller than those allocations.
Sure.
But I don't typically invest in individual. I'm looking for funds where they're playing the, let's call it 10 investment model, where you're going to get snails. The majority are going to be snails. You need like the 2 to 3 to hit.
Yeah.
And then I enjoy entrepreneurs. So I do make investments in like early round startups.
Yeah.
They're high risk though. It's a smaller percentage of my allocation.
And, hey, look, that goes back to the earlier point. That's like, how much time are you willing to invest in the entrepreneur? Because I find this is me to a nutshell when I was building businesses in general, or like I haven't stopped building businesses. You know what I mean? I was making mistakes because I didn't know what I didn't know, and I had someone alongside of me,
right,
to educate me. Hey, watch out! Hey, that's actually a ditch. Watch out for that. Or hey, that's actually a really good opportunity. Or hey, dude, your leadership. We got to work on your leadership, man. You're killing these teams. I think that's a special skill set. And to your point earlier, when I invest in business owners, that's what I'm looking to do. Is I'm going to come alongside of you as one part mentor, and then one part investor, which I think has turned out to be a pretty good strategy overall.
That's good. That's really good.
I know we have just a couple minutes left, and first of all, thank you for the masterclass on investing. I find that there's more people looking for ways to deploy capital. Especially as there's a lot of movement right now in M&A, a lot of movement.
Yeah.
One of my investment bankers called me recently, and he goes, "Do you realize they're paying multiples of 12 for roofing companies?" I'm like, "What?"
Yeah.
I'm like, "That's normally like reserved for tech space." I'm like, "Holy cow." That's probably there's probably a small window that's going to be happening, but there's a lot of folks in that space.
Right.
I say all that to say thank you for the masterclass.
Yeah, of course.
I really want to have folks continue to get to know you and more about what you're doing, especially as they're looking to deploy capital, as opposed to maybe another entity or firm or thought leader that may be a bit more risky.
Right.
I'd rather them be with somebody who's common sense, humble at heart, and ready to get going. I'm curious to know kind of a final question for you, because I love your mind so much. What is something you've been dying to talk about, either to your audience or audiences in general, that you've yet to really kind of bring to surface?
Oh, that's good. I don't know. I would say I more talk about the things that are currently happening in my life, right? We're doing real estate deals, so you're going to get a lot of real estate from me. But I'm a dad and a husband. And I have young kids. I have 4 of them, ranging from 11 to 1. And so, I mean, honestly, a lot of the challenge and struggle that we're really going through is, how do you have a healthy relationship with your wife or your husband while you're trying to raise kids, right? And so, I don't know. It would probably be probably around that. Like, I'm a father, so I would probably, the things that I'm thinking about that I don't talk about, how do I be a good dad, a good husband, and a good example as a business owner to my kids, knowing that I am the example that they're seeing for my girls on what a husband's going to look like, and for my son, what a man's going to look like, right?
That's right.
And dude, there's a lot of pressure on that because they see all my weaknesses as well.
And they pay more attention to what we do than what we say.
We don't pay any attention to what we say, right? Things are caught, not taught.
Yeah.
And so, probably around that, man. Like, how do you maintain a healthy relationship with your wife and not have the entire focus become on the kids?
Yeah.
We do a lot of, whether it's marriage counseling or marriage retreats or in a marriage group, we spend a lot of time on that. So I'm constantly learning, but that is hard, man. Being married and being a dad is hard.
Yeah, it really is, and then trying to make an active movement in the public obviously is difficult. This one of the things I was just thinking of too is, something my oldest son told me. He just graduated from Campbell literally last week. I flew back from North Carolina to go watch him graduate, and probably a year or so ago, he sat me down. We were having dinner at a Mexican restaurant. I went to go hang out with him at the college or whatever. We're sitting down at the dinner having at the restaurant. My audience has heard this, so it won't be anything new to them, but maybe it's something that resonates with your audience. He told me that the one thing I needed to work on.
This is your son saying this?
This is my son saying this.
Okay.
Adult son, basically 20 years old at the time. He said, there's one thing. He says, you were a great dad. You're a fantastic husband, but there's one thing you can work on. Just one thing. It would be something like this. And I was like, okay, well, now I'm all ears. And I'm going to be honest with you, it changed my life. Like ever since this moment, it changed me. He said, if you could learn to be more present when you're present,
Yep.
get
That's
off
the
your
entrepreneur curse
the
right there.
computer,
Yep.
the game, whatever that thing is. And, I pretty quickly reinstituted, what we call them date night. I guess you call them date nights, boy hangouts, so whatever you want to call them. But the one-on-one time attention, I've really focused really hard that like, okay, at this time of day, I'm off the clock. You can call my phone. You can be one of my ideal clients, and I'm off the clock. Because to your point, they're watching.
All right.
And I want to be a good man. I want to be a good husband, be a good father. I want to be great at those things. Because I find that, and I was a person of faith. I find that stuff means more in heaven than how much money I made.
That's right.
You know what I'm saying? So anyway,
that's right. Yeah, that's right. Yeah, I think that look, that's I would probably say my number one struggle as well. I think it's for entrepreneurs. It's hard, right? Yeah, I'm with you. We do the I date my daughters. I take my daughters to, we do breakfast on Saturdays or my son, go golf with him. But one-on-one time and put the phone down, that ends up resulting in the highest return out of anything we talked about today. It's always quality time and presence.
Quality over quantity, ironically.
Yeah, 100%.
Yeah, 1,000%. Well, dude, I love you to death, man. I can't thank you for coming back on the show and schooling us again today. Where can everybody find out more about what you're working on? The best way to connect with you? I know you're all over social media. Obviously, you're on YouTube, got a growing show, all the good stuff. Where would you like everybody to go find you? Yeah, so regardless of the platform you're on, just search my name, Mikey Taylor, and you should be able to find me. If you listen to podcasts, our podcast is Life with Mikey. You can find it on any of the podcast platforms or on YouTube. And then our company is Commune Capital. So same thing, search Commune Capital on any of the platforms, or our website is communecapital.com. I love it, dude. Thank you so much. And I apologize that my Southern twang messes up Commune Capital. You're all good. Thank you, brother. It was great to see you. Awesome, man. Take it easy, buddy. See ya. I hope you liked that video. And if you did, make sure you check out this next video right here.
Email still has more daily active users than any single social media platform. 4.65 billion people are doing stuff with email every single day. Why? Because it's one of the oldest communication technologies on the internet.